My name's Dave DeBow, founder of MoneyPartnerFormula.com, and this show is built for everyday real estate investors who are actively doing deals and looking to scale using other people's money. So if you're an active real estate investor and you want to get featured on this show to talk about your own real estate and capital raising experiences, then just go to daveinterviewsyou.com. Now let's get rolling with this episode, and remember to subscribe for daily interview content.
All right, guys, welcome to Property Profits Podcast. I'm your host, Bryce Kaminski, filling in for Dave DeBow. And have you ever wondered how private credit can unlock new opportunities in real estate investing? Well, today, my guest, Denver Lobo from JT Capital, he's going to shed some light on this intriguing topic. Denver has extensive experience in managing multifamily apartments across the Sunbelt states and has a keen insight into the evolving landscape of private equity and private credit. Denver, welcome to the show. Great to have you here.
Thanks, Bryce. Great to be here and share a little bit about our story, where we started, and how the listeners can kind of do the same or invest alongside us and really get access to an asset class that you think of only the ultra wealthy or the 1% can invest in. That's just not the case anymore. Everyday people who do really hard jobs and are looking to, put their money to work outside of a bank account that earns them nothing, should really look at multifamily, look at private credit, which I'm excited to share with y'all, to really grow their capital and, change the game for their families.
So yeah, let's start there. Give us a brief overview of JT Capital and its focus in the real estate market.
Yeah, sure. So JT Capital is a real estate private equity firm. So we own and operate high quality multifamily apartment buildings. Most of them are 200 unit plus type buildings in Texas and Florida. You will find operators that do the entire gambit, multifamily, industrial, RV parks, self-storage. We are solely focused in that high quality multifamily space to kind of be best in class as an operator. If investors are thinking, I want to put this to work in high quality multifamily, we want to be that offering for them rather than sort of, be everything to everyone. We've just found a lot of success kind of sticking to a niche. You understand the space a lot better. The network you build is very targeted. And then over the years, it compounds on itself. And so this company was founded by siblings. The co-founder has been in the space for about 15 years doing commercial real estate, ex-Blackstone, passionate about commercial real estate and really bringing that asset class to investors. His sister was ex-Hershey's, doing marketing there, and so moved over kind of to build the brand of the company and to really get the word out. And both of them have built an amazing company. We have almost 2,000 investors, 1,600 units under management. At the highs, we were around 6,000 units. We've been selling a lot over the last couple of years, given the ridiculousness that's going on in the markets that we'll definitely touch upon. And so overall, over a 15-year sort of time frame, our track record is we've transacted in about $1.5 billion worth of real estate, owned about 6,000 units, raised about $350 million in equity, and currently we are around $450 million in AUM.
So that's that's a lot of multifamily real estate, in the sense that the better units usually cost a little bit more. You could have probably taken that money and bought more for in lower class neighborhoods. But if you're trying to get that the more consistent, maybe not so high cap rate sort of thing, then it usually costs a little bit more. But my question, I guess, is what initially motivated you to start in with this multifamily apartment thing, especially in the Sunbelt?
Yeah, for sure. So my background is I'm originally from India. I moved to Kuwait when I was very young. And I grew up there, kind of saw that part of the world, got to, very lucky to travel a lot over there. And while I was thinking about college, I said, hey, I really want to go to the United States and go to college over there. So I went to Notre Dame. And right after sort of earning my finance and economics degree, I moved to New York City to do investment banking. It was sort of the quintessential thing to do at the time.
Yeah.
And that start was amazing because most people, I would say, hate their experience in investment banking and, can't wait to get out into the private equity world. My case was completely different. I joined there. I stayed there for about 10 years, loved the team, loved the asset class that I was sort of in. Raised about $4 billion worth of capital, of debt capital from institutions in the US for projects, not only here in the US, but also in Latin America, non-Japan Asia, and then also EMEA, so Russia, Turkey, South Africa, for example. And so had a blast with that. Throughout that journey, read the quintessential books of real estate. So Rich Dad, Poor Dad, all these books that I might have read 100 books. And each one I sort of took one step closer to buying that single family rental. And once we bought it, we just fell in love. We said, this is the asset class that we want to sort of proceed in. And by the time I sort of was ending that investment banking career, like real estate became almost half of my net worth, and I sort of wanted to take it forward to the next step. Which once you've bought a single family, you go to a duplex. I know you're looking at an 8-plex right now, which is super exciting. You keep trying to double that over time, right? That's the only way you get up to those 1,000 units, because just buying single family, you're just not going to get that 1,000 units, by the time I'm probably 60. So that's kind of where I got my start. The reason multifamily is because the economies of scale. And the easiest way to explain this is when you have a single family home, you literally have one roof, right? That roof costs about $30,000 to replace. With a multifamily home, each building has, let's call it 50 units or so. That roof, might cost 40 or 50 grand because it's bigger, but it's spread across all of those costs, and those economies of scale are ginormous. So that's why we sort of look for 200 unit plus apartment buildings, so that we can hire on staff management. They can do the leasing full time. They really know all of our tenants really well, and you get massive economies of scale rather than having single family.
Yeah. It kind of comes back to what we were talking about before the call. It's like, is that what people are going for? Like, really, I always say real estate's a tool. So what do you actually want out of it? Could you get what you want out of it by buying a handful of single families and that would be satisfying for you? Yeah, maybe. Or you invest in a REIT and you can get that return that's satisfying for you. So it really just comes down to, and I think people, when they're investing in real estate, they can get sucked in a little bit into this, that, or the other, but really just realizing, like, what do you want real estate to do for you, and choose that tool. We don't just go to the job site with a hammer and hit everything. So figuring out kind of where that lies for you as an investor and as a active investor, someone who's making those moves, really, I think is one of the most important things, because maybe doubling the size of the units isn't even possible in the market you're in. So you might have to start looking elsewhere, and that really doesn't fit into your lifestyle. So for this whole private credit and private equity with real estate, how do private credit and private equity intersect in the real estate investing space?
Yeah. So before we jump in there, you just mentioned something so important for all of your listeners. It's, do you want to be an active investor or do you want to be a passive investor? Now, you can have a full-time job and still go out and buy single family. I did this. I did it doing 80-hour weeks in investment banking, and I had, 10 single family properties. It was a slog, but you can do it. Every single person on the call can do it if they put their mind to it. On the other hand, if you do 80-hour weeks, and you have kids and you have other responsibilities, and you say, hey, I'm really good at my job and I can make a lot of money, but I don't have time to get tenant phone calls at 2 a.m. and do that rigmarole. I want to be a passive investor and get access to this asset class that is much better than not getting access to the asset class and putting your money in a bank. So
a
the
mutual
question is,
fund or
yeah,
whatever.
exactly. And the private side of this, because of how sort of the investment works and the concentration of the investment, you are able to get a little bit of a higher return than those public market equities and mutual funds and REITs, just because of their size. They're massive in size, so they have to keep a little bit of a cash buffer, which reduces everyone's returns. Let's say the fund is $1 billion, and $50 million just sits on the sideline just for anything that comes up. That $50 million is not earning anything. So your returns as an investor in those very large public REITs and whatnot is a little bit muted. And then the larger you get, the more macro your investment becomes. What is the Fed doing? What is the interest rates globally doing? Are governments turning up the sort of the tap in terms of pushing money into economies, or are they taking it off? It becomes much more of a global play than how targeted we are. And so that was just such an important point. So I just want to bring that up. So private equity and private credit. I'll sort of explain both. So private equity is where, let's say we find a 200 unit building, and and let's say, for example's sake, its value is $40 million. We will typically raise about 25% of that $40 million with LP capital. So investors like you and me saying, hey, I want access to this, but I don't want to manage anything. Here's my 100K check. Here's my 250K check. Please go buy it. I was never going to get the call from a broker to buy this asset, but you did. Great. Perfect. So private equity is just that. It's that $10 million sliver of this whole project. And the private equity part of it is you're getting access to this building. You're getting access to quarterly distributions. If we sell this property for $60 million at the end of the term, that $20 million is actually on top of only the 10. It's not on top of the 60, because we're just paying the bank back exactly what they gave us to borrow. But your money is going from 10 million to now 30. So I've 3x your money if I sell it at that price. So that's the private equity side of the business. The private credit side of the business is saying, instead of a bank, you go to a non-bank lender. So an entity like a private equity firm, like us, for example, where you are directly lending to a multifamily sponsor. So let's say, for example's sake, the sponsor has this 200 unit property, it's $40 million. They will come to us for that 30 million sliver now and say, okay, how do I get this 30 million sliver? Or even something smaller. That's private equity, where they're not going to a traditional bank to get this line. They're coming to us. And the reason this is coming up is because how dislocated the market is, mainly driven by interest rates, I would say. Everyone's heard interest rates are astronomical. Buying a single family home, if you're in the market, you know how hard this is. You've heard the stories. It's just as hard in the multifamily space. So what happens?
I might even say it's harder these days, because the banks are tightening up a lot on the commercial lending. Like the government's still doing kind of handouts to get people into homes, FHA loans and this and that. But there's no help in the $10 million apartment. They're not like, oh, let's give them grants. Like, no, like, go figure it out, guys. Your capital.
Oh, totally. Yeah. They want to help individual people, but they're not going to want to help a private equity company that's, in it to make money, right?
So is that where you're
so
doing like bridge loans then? You guys are doing
absolutely,
some other investor in another apartment. So you're able to kind of capitalize on they're trying to refi, or they came up short, or the bank, or they ran out of renovation money and they need to get to the refi line for the bank to turn it around. And they come to you and they say, hey, we need more money. And people are investing in a kind of LP way into that fund that is then lending to these shortfalls on, I don't know, bridge loan type things, all sorts of reasons why people come up short.
That
And
is,
they're
yeah,
getting an interest return on that. So people are investing with you guys in two ways. One, directly as an LP in equity, and the other one is like they're pretty much joining together to do bridge loans of the size and magnitude that big multi family requires. You can't bring
and you just,
150,000 to
yeah,
the table,
and,
right?
and you just summarized private credit in a nutshell there. That's exactly what private credit is. So getting a
Well,
bunch of people
we're seeing
together.
it, right? We're seeing it
Yeah,
popping up more and more. This wasn't so much a conversation topic 2020, 2021, because while interest rates are at like 3 and people are going crazy, they're like, oh, multifamily, and they're buying tons of multifamily. And then 24 months later, they're going to the bank and they're saying, I'd like to refinance now, or they're getting real close to stabilization, but there's a gap. Costs have gone up, holding costs have gone up. Maybe they were in some sort of weird variable interest rate where it was pacing the prime, and now they're short. And there's, I've heard this strategy a few times from a few different multifamily kind of fund of funds things, where, and same with sub two category, they've got these connectors where people are coming in and they're saying, I need a bridge loan, I'm short, and then the interest rate's like 30%. And it's like, how bad do you want that bridge loan? Well, pretty bad, because if we don't get it, the project stalls, we can't get to refi. All the investors' capital is kind of sideways stuck into whatever high interest loan they put together to get into the original purchase, right? Because sometimes the bank doesn't like to be part of the fixing process. They're perfectly fine holding nice things, but they're not super excited about like redoing the crack shack that is a big building or was subsidized housing or something, something that maybe has been kind of a rented mule and needs a lot of work. The bank's not super excited. But when you bring it
yeah.
to the fix, they are. So what sort of do you see that credit? Is that bridge financing sort of side of things a new development for JT Capital, or have you been doing that historically through the length of the company?
Uh, Not for the length of the company, but we've been doing it a long time.
Mhm.
And so this private credit in multifamily specifically did not exist for the last 15 years. And the
Mhm.
reason is they had three options. One was go back to their bank and say, hey, I need $2 more million. I owe you 40. Are you not going to really give me $2 more million? The bank traditionally for the last 15 years has said yes.
I like how you
Right
use the
now they
word
are,
traditionally, because
yeah,
we're not in a traditional marketplace.
we're not in a traditional market. Right now they are saying no. The second thing is going back to your investors and saying, hey guys,
Tough call.
we projected this, but we had a unforeseen error in projections and we have to do a capital call. Super frowned upon right now, right? There's a
Yeah.
lot of operators getting a lot of heat for this. Now, can you have projected that things went up so fast in terms of interest rates? There could have been risk mitigation done, but no one expected this. And so, also for the operators, I don't put all the blame on them. It's just the situation right now. And so, if they can avoid a capital call, they would do it at all costs. The third thing is they can go to very large private equity firms that do what we're doing. So think you're like BlackRock, Blackstone, Oak Trees, large private equity firms of the world. Now the
Mhm.
problem is that these guys have $2 to $3 billion funds. If they had to write $3 to $7 million checks for each one of their assets, they would be pulling their hair out. They'd have to have analyst teams of 500 people. It just doesn't make operational sense for them to write these assets. And so no one's doing this space. No one's doing this very intriguing 3 to 7 million space. Amazing asset. With lending, it's you have to be as focused on the borrower rather than just the asset. And so we're finding these great opportunities. Like the first one, is a situation in which there's a uh, newly built property in Long Island City, New York. If I hop if I do a 4-minute walk, I can get the train to New York City, and it takes me 20 minutes to get there. That's the location that we're looking at. 97% occupied, built in 2021. This operator is willing to borrow our capital. It's a $5 million check, borrow our capital and pay us a 16% minimum return for the year. And he expects to refi us out in 9 months. Like, why wouldn't we sort of look at opportunities like this as long as they last? And the reason that it makes sense for the operator of that business too, and why he's borrowing our capital, is if he does an equity call, that equity is going to stay for the entire life of the project. Ends up actually being more expensive than my capital if he's just like, hey, I need this for the refinance, as you mentioned, and then take you out and, goodbye, but thanks for helping out. It's also good to make those connections at times like this where you're helping out,
You're not
third
giving
generation
away,
developer
you're not giving away equity.
in a project. Exactly. So what I'd encourage, listeners to just learn a little bit more about is like, what is private credit? How can you get involved? How does it differ to just buying a multifamily outright as well? Like, for example, the investment that we are making into this company is known as preferred equity, right? And so the difference is that we have priority over the common equity in the
You're
deal.
paid
So
first.
exactly. So two scenarios here. When rent is collected, our returns are paid before any of the LP, any of the GPs get anything. Upon sale, we get our capital back, we get our returns back before any LP, any GP gets their capital
And
back.
same with a refi, right? You're gonna get
Same with the
preferred position.
Yeah, but like the plan is to take us out at that point and rinse repeat. So with common equity, you typically have to be in the project for 5 to 7 years for that to really take fruition and pay off. This is a 9-month hold, and we're kind of rinse repeating with projects like this within the fund, and we kind of have a 3 to 5 year fund. So that's private credit for you. That's kind of
I know
the little bit of
people
a
are
nuance.
moving into that space too, because there's a lot of that happening on the flip side of things where people are flipping property and they need a bridge loan to close. Maybe they raised 80% and they need the last 20%, and they're willing to pay 30% interest on the last 20% to get the deal off the ground because they know that they can afford 30% on $30,000 for 6 months. It's not ideal. They would have liked to, raise some money, and maybe they raise some money and clear it out, get it off the table quickly. But
and what you're saying is really great, because it shows you that, like, for our fund, that $30,000 check would not make sense. And mainly because if I did $30,000 checks, it would take me, light years to sort of deploy all my funds. So there's a market for sort of each section of the not only the check side, but also the risk profile, right? This is a property that you just mentioned. It's one single property. It has to sell. It's very concentrated risk, right? My multifamily property is 143 units. It's 97% occupied. There's like a lot of diversification there that you're getting just because of the asset and the quality and the number of tenants. So we are sort of looking at this as stabilized properties that are in really great locations, rather than development of even large scale properties. So we just feel much more comfortable with these assets, mainly because we're wearing two caps. It's like we're wearing our own owner operator cap, which we own these type of class of properties, and then we're wearing a lender cap where we're saying, hey, we've used this before, we know how to be helpful, we don't want to hurt your business, we want to actually help you get to the finish line, which is this refinance or sale point. And so seeing
that
huge
too,
amount of
when
opportunities there.
there's a lot of lenders that were doing 100% loan to value, and now they're doing 80. So if you need the 20, you can buy any amount of money with lesser amount. People will leverage on against the asset, but you do have to, in your guys' position, like you're saying, you're gonna have to vet that operator. That's what I've been hearing, especially from connectors. These are gators in the sub two community where they're vetting the likelihood that the investor is going to be good for it. Because, being the last 20% on an equity stack is not a super secure position. The bank and the first lender who gave 80% is not going to take a second seat to your 20%, especially on like flipping or small multifamily. They're not, they're not going to let you be first in line when you only brought 20 grand to the table at 30%.
Yeah. Yeah, exactly. And so your percentages are 80 and then 20.
Yeah.
Where we sort of fall after our investment is anywhere from 60 to 70. So you can kind of see how much lower of leverage these type of larger properties have for us to get excited, because if it was in the 80s, we probably wouldn't be making that investment.
And that's the thing, like that's where some of these high interest bridge loans come in, because they're like high risk, high return. Yeah, lean the property and pray that you get your money back. That's about it on some of these things. So we could dive deeper and deeper and deeper on this. I think the best thing to do is for people to reach out, find out more about what it is you guys do and what you have available. So if people want to find out more, they want to connect with you, what should they do? How do they find you?
Yeah, I would say the two ways is LinkedIn. I'm very active on LinkedIn. Just follow along. I have a lot of education on there just to kind of, educate our current investors, bring more investors through the pipeline, and um, you know, investors, at least our investors, are very used to multifamily deals and single assets. And so the idea of funds requires some education. We're providing that education. So if you just want to learn more, just follow along. And then if anyone wants to email me, it's denver@jtcapitalgroup.com.
Awesome, awesome. Well, Denver, I really appreciate you stopping by and letting people know that there's yet another outlet in which the everyday person can get a decent return on their capital without being the active investor that maybe they just can't be for or don't want to be. So that's awesome. It's you got to love the capitalism in it. So all the best.
Yeah,
And I
exactly.
appreciate you stopping by.
Thank you, and you seem to be really well versed in this, which is awesome. So
I've
thanks for
talked
having me,
to
asking some great questions.
I've talked to a few people in the space, on the multifamily side of things, and you know, it wasn't that conversation was even happening in October last year,
Hmm.
in December, October, November, but then January, February, March, April, it's starting to, these capital companies aren't just doing asset, they're not just buying assets and managing them. They're also saying, okay, well, if the number of opportunities to buy good cash flowing properties is lower, how can we get involved and still keep our partners, our LP capital in play? And that's by lending to people who are already in these other deals, and then actually just underwriting like crazy and waiting for better deals to put your money into. So I see that with these capital funds, that they are getting more active. They're like, how can we deploy all our capital and also protect our investors' money? And you're seeing it, you guys are doing the same. You're also buying, but you're also lending, because there's sellers, I think, still want too much in some cases for these A-class assets. They're not recognizing that there's been a shift. It doesn't, you sit down and do the underwriting, it doesn't add up. So you wait. You're like, I'll wait until you come down in price or the market appreciates. And until then, we're going to lend our overflow capital and into projects that are more viable and there's a secured return. So
Yeah, yeah,
very
exactly.
smart.
And how we're sort of thinking about it is stick to one niche kind of asset. Don't stray too far away. There's going to be plenty of opportunities in your niche. Just like we see operators sort of doing something similar across industrial, across multifamily, across different class of multi. It just It's tough.
I've seen,
It's tough to just do what we're doing. I can't imagine how operationally heavy that would be to, run one of those other funds.
well, I've seen my fair share of investors die on those hills in that sense that um, either they get shiny object syndrome and they're chasing the next Facebook ad that says now it's time to do RV parks or now it's time to do, self-storage. But the people who stick to their buying model, I think, always come out ahead. There might be a flash in the pan like strategy that's making people a little bit more capital this year than last. But when it all comes down to it, the fundamentals of LPGP and large format multifamily, it doesn't get any more secure. The most asset managers and properties under management, as soon as I see that the company comes in and they buy a 100-unit thing, I'm like, that's the last time that's coming up for sale in my lifetime, because they're just going to sit on it. It's going to be beyond our days when someone decides that it doesn't fit the asset class, or maybe never. It may never come back up for sale until that company is merged or dissolved. And that's really what it comes down to, is the fundamentals of getting into, especially with the housing shortage. Like multifamily they're only going to build more, but they can't build it fast enough. So the value of it is kind of like a subjective, I want more. And the investors are saying, well, it's not worth that, so we'll wait. And so there's a little bit of a power struggle, but I think the most safe investment, especially as a passive partner, you don't want to be throwing money into like a flip necessarily if you're a passive partner. That's a kind of like two people getting in a dune buggy and going out into the desert, like we're going to make it. But when you've got a boat full of people and knowledgeable operators on the GP side, it's like an airplane. There's 300 of us on it. We put our headphones in and we get our return in 3 hours or 3 years, and the same thing where it's like you're just on an airplane, you're taking a trip with your money, and we don't get on an airplane and go, oh, is it going to work out? You're already committed to being on the airplane, and they bring you a little bit of some pop and a little bit few peanuts, and at the end of the trip you're in Hawaii. And I think that's the easiest way to look at these LPGPs, is like it's an airplane. You want to invest on a small scale with people that friends and family, cool. That's more of like off-roading with your buddy in his Jeep. Are we going to get stuck? I don't know. Is he any good at driving? I heard he is.
Yeah, that's a super analogy.
Do we have professional pilots up at the front? Yes. Have they flown this, for the last 30 years? Yes. Is there 300 other people that they're responsible for? Yes. Okay.
Yeah.
Sounds a little bit more like a sure thing. So, the website again is?
It's jtcapitalgroup.com.
Awesome. Well, Denver, I really appreciate you stopping by. And until next time, guys, we'll catch you on the next episode.
Hey there, I really hope you enjoyed that episode. And as always, if you want to listen to more daily interview content, make sure you subscribe. And if you're an active real estate investor and you're doing deals and you'd like to get featured on this show, then just head over to daveinterviewyou.com. Now at moneypartnerformula.com, we help real estate investors to create a process for predictably getting capital so they can do more deals without relying on hard money lenders or the banks. We do this by building them a private capital marketing system. Now, if you want help turning yourself into a big money capital attraction machine, then book a call with our team to see how we can help. Just visit moneypartnerformula.com to find out more. All right, take care, and we'll see you on the next interview.